right, before we pass off the mic to our main presenter tonight, I just want to run through a few slides. Who is not familiar with Quest or what we do? Okay, so we have a few new people in the room. So just to give a brief overview of Quest, we are a self-directed IRA custodian. We hold alternative assets such as real estate, promissory notes, private entities, and a whole lot of other options. As you can tell, we love to offer free education like this networking event here. We also have Tuesday and Saturday webinars. And we even host bigger events, and I'll talk about that in just a second. So for those of you who are unfamiliar, self-directed IRA, it's really just a marketing term. The IRAs that we have here are no different than the IRAs you're going to have at any other custodian. Really what sets us apart is what we allow you to invest into with your IRA, which is alternative assets. So like I said, real estate, notes, oil and gas, cryptocurrency, the list goes on and on. If you have any questions about how to use a self-directed IRA, feel free to come talk to me after the presentation. And like I said, if you're looking for additional education, we have our Saturday and Tuesday classes. We have a national networking happy hour that is virtual. And then obviously we have a ton of education on our YouTube channel. The last thing I want to talk about before I hand off the presentation is our QuestCon event that we are hosting on December 9th and 10th. So this is an event that we've been doing for about 3 years now. It's going to be December 9th and 10th, like I said. It is a completely virtual event. And what we're going to do here is we're going to spend one day kind of reflecting on what's 2022 has looked like, and then we are also going to forecast into 2023. So if you're interested in finding tickets, just come find me and I'll give you more information. But without further ado,
can you hear me? Thank you, Katie. Does that sound like it's coming out? Is that right? Okay. My name is David Kapavik. I'm with Southstar Bank, but not only have I been a banker and have been a customer with before the people that are well invested, mingling together and learning from each other, whether okay. Got a little presentation here. We're gonna go through it, and at the end of the presentation, we'll have a formal question and answer session. But during the presentation, if you have a question, feel free to ask. I think it's good to be interactive. The only negative thing is we won't have the mic at this point, but I will be able to hear you, and I'll try to reiterate the question, but if you feel more comfortable waiting toward the end, that will be great. You can have a mic in your hand, but open to any suggestions, recommendations, or questions that you have along the way. So today what we're going to be talking about is being able to acquire a loan to be able to help finance IRA properties, real estate properties. And our title is Unlocking Greater Returns for Your Real Estate Investments. And you know, it's like any other leveraging that you do. You have to be careful, you know, how much you leverage your portfolio. However, it gives you an opportunity that you may not otherwise be able to take advantage of. So, you know, we want to talk about what all is involved in being able to acquire a loan, and we'll go through the process of this, but let me see if I can figure out this clicker here. All right. Oh, went the wrong way, I guess. There we go. Okay. All right, so this is just a little rundown of the things that we're going to talk about. The borrower relationship. If you're going to acquire a loan, you need to have a relationship with a lending institution. The advantages of having an IRA loan to help fund your self-directed IRA properties. What it takes to qualify. A little bit about the approval process. And then some information, technical information about the debt coverage ratio, how banks look at qualifying the specific property and what type of returns that you need on the property for it to be able to qualify. This should be online, if I understand Katie right. This is gonna be posted tomorrow as well, and it will be on the YouTube on the site if that helps you. But you can take pictures of me all day long if you want. All right, and then we'll wrap up with the frequently asked questions, and you may come up with some other questions. We try to, put some out there that we normally get from clients, and we actually we had a booth at the expo was a couple weekends ago, and so we try to update our presentation to include some of the questions that came up during that expo. We had a lot of interaction with customers of Quest that were looking for IRA investments and potential customers for loans. So, borrower relationship. Okay, let's see here. All right, so how many of you said y'all have self-directed IRAs already? So they're familiar with this, and those of you who may not be familiar with this, there's some other basics that may have to get into, but I'm trying to kind of run through what it takes to be able to get to the point where you can borrow money. And first off, it involves setting up an account with a self-directed IRA company such as Quest, who is the custodian in this case, and you as an individual. So you contribute your IRA money and put it in a vehicle that allows you to invest in self-directed assets. So jumping right to the loan part of it, the thing about a self-directed IRA, the way that the IRA, the IRS tax code is written, an individual who owns an IRA cannot guarantee an IRA loan. So essentially it's what they call a non-recourse loan, meaning that the loan is to the IRA itself, but you don't personally guarantee it, you don't personally sign on the note. So in this case, the custodian, who is Quest, let me take a step back. You find a property you want to buy, and we'll go into more details on individual properties, but you find a property you want to buy, you get a contract, you come to Quest, you have your account set up, and then you say, hey, I want to buy this property, but I need to borrow additional amount. I have 100 of the 200 that I need. And so you go to Quest and you coordinate this through Quest and work with a banker institution that does the lending and coordinate that, but it's really Quest who actually executes the note on your behalf, on behalf of your IRA. So there's an executed note and a typical deed of trust, just like you would have on a conventional loan. And then, so the payments on that note don't come from you directly. It comes from your custodian account, your IRA account. Likewise, you'll see the income also comes into that account. But so the next step there is the way the bank works is you have this note and deed of trust, and so you have the rental property that's pledged as collateral to the bank. The bank turns around and lends up to 60%, non-recourse. Your personal name's not going to be on the note. It's a simple process, which we'll go through a little later, of qualifying. But we typically only lend 60% because it's essentially a collateral-based type loan, and that's why the advance rate is typically lower than what you would have on say 80% for a conventional loan, because your name is not on the loan. It's the IRA who is actually signing on your behalf. So then, on the rental property, the income goes back up to the custodian, goes into your account. Then, payments are made, taxes, everything that needs to be paid. So it's just sort of a complete circle there, to where just like anything else you do through the self-directed IRA, the money never comes to you. It always goes through your custodian to keep it separated and for tax purposes, to keep it tax-free or tax-deferred. So that's sort of how the system works. And does this sort of make sense to you guys? And I'm open to questions because we got a kind of little diagram going here. Yes?
So credit score doesn't even come into play?
Question, and I'm going to repeat the question if you don't mind, because they are recording this, so people that may not be able to hear it. The question is whether the credit score comes into be, and no, it does not. The reason it does not is because the loan is not made to you. Obviously, you need to be creditworthy. What we find is people that are investing their IRA money are typically people that have made money, are good business people, and it really doesn't matter at all because the loan is not made to you personally. Yes.
And because you're lending, is that going to trigger UBIT tax? Because you're borrowing?
Yes, the question is that UBIT tax, unrelated business tax, and yes, on the portion that you borrow, yes, you will have to pay taxes just like you would a normal property. But the beauty of that is that as you pay that loan down, the percentage that you pay taxes on becomes smaller and smaller. And the other thing is, hey, you get an opportunity to buy a piece of property, so what? You have to pay some taxes. But if you sell another property and want to pay that loan off, or you get enough return on it, it pays it off. Once it gets paid off, then there's no taxes, or it's deferred taxes if it's a traditional IRA. So yes, that is something you'd have to talk to your CPA about. But remember, you get depreciation, you get to write off all your expenses, and so it's no different than traditional investing. Yes?
Terry, what happens if my IRA declares bankruptcy, Chapter 13?
Well, I don't know if that's probably a question, but I don't know if your IRA can declare bankruptcy because I don't think it needs to. And I'm not an attorney here, because those assets are protected. Those are protected assets that you hold in your non self-directed account. Now, you wouldn't necessarily declare bankruptcy, but just say, for instance, you get to the point and you have some problem with the property, you can't rent it. You have some storm that destroys it or whatever, and you walk away from it. Essentially, the bank is left with collateral there that is probably worth less than an expected, but that's the risk the bank has to take. And I don't think there would be a formal bankruptcy. There's no reason. It would just disappear. You would forego that asset, is the way I'd understand it, but that's more of a Quincy Long question. Yes?
So if it's non-recourse, then does that history of what has happened with previous property still go to the custodian? So now the bank will be less likely to go to give money next time?
Not necessarily. Now, if you had an experience, the question was whether or not if there was a bad experience with one loan and whether that would hurt your credit going forward. I will tell you, if it's with the same bank, they're probably going to remember that account and remember that custodian. But I guess you could research it and find out that particular IRA had a foreclosure. There is a possibility that could happen, that it could hurt you because somebody could look it up. But in most cases, it's not going to be a direct relationship. It's not going to be like your credit score that gets affected, or where you get to see the payments that came in. But the bottom line is we all want to pay our bills. We want to take care of our business, because what we're trying to do is build relationships. We're trying to build relationships here. We're trying to build relationships with lenders, with other investors. So obviously the right thing to do is try to take care of your business. Yes, sir. The question is, and correct me if I'm wrong, if this is legitimate lending, why don't all banks do it, sort of type question? Why isn't everybody doing it, or what's the catch? Is that what you're saying? Okay. Okay, so the question is, why would any bank want to do a non-recourse loan when they could do a recourse loan and get somebody to guarantee it? Okay, so the main key in our mind is, number one, we're dealing with investors that have savings, and they've shown the propensity to save, the propensity to invest wisely. And yes, you're right. In most cases, most community bankers run from this. They don't want to understand it. We are one bank that wants to understand what you do. We put a lot of rationale into it. And my thought is, this is typically a great group to lend to, because they're prudent investors that have cash. Most 1 to 4 family home loans, they take an application and people have zero cash in reserve, or 3 months worth of reserve. What we find is this is a better group, because they're more sophisticated and have the ability to be able to manage their money, and have shown that. Now, the other piece is, we typically only lend 60%, because we're not getting that recourse. We just have to rely on that collateral. So the typical lending, the lenders that fill this space historically, and still do to today, that serve a legitimate purpose, are the hard money lenders. Now, on the hard money lenders, they're taking a lot of risks. They do a similar deal. They don't probably ask any questions. They get into crazy deals, but they do typically charge quite a few points up front, and they charge a pretty exorbitant rate. That's just that business. Okay? But we are a standard community bank. We've been around 102 years, and we've learned a lot through the years. And we don't think we don't have to charge an exorbitant rate for these. The loans that we do here are at the same rate that we do 1 to 4 family rental properties. And the main difference is, on a conventional 1 to 4 family, we have the guarantee, but a higher loan to value. On these loans, we have typically the same rate. We don't have the guarantee, but we have more equity into the property. We have a higher equity portion of our collateral. So that's the main difference that I see. Does that answer your question? Right. That's the mitigating factor, and one of the main mitigating factors. Like I say, it also has to do with the class of people that we're dealing with. They're investors and savers. Our interest rates are very similar to the same product that's conventional. Yes.
Will you be telling us what the requirements are to qualify for loans?
Yes, we'll hit the high top. We won't go. I think we'll go through most of them. We are. Okay. Question is whether we're going to go through the requirements of qualifying here. Is that all the questions for right now? Okay. Can y'all still hear me? Okay. 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 So what are some advantages here? So we talk about leverage. A lot of times that's something that has a negative connotation. Leverage. You can get too leveraged. I was talking to some of the people. I was around in the 80s. I actually was a bank examiner and saw a lot of borrowers get into a lot of trouble being over leveraged. I saw a lot of banks fail. So you have to respect leverage. but it can be your friend too. It can be a nice tool for you to help you. You just have to keep it in check. You have to make sure that if you're going to take that leverage, you still have the ability to make the payments, and you don't lose that property. You don't get behind on that property. And so the way you use that leverage is that if you're wanting to buy a piece of property and, it's $100,000 and you only have 60, or you only have 40, you can borrow the 60, and so that allows you to buy something that you wouldn't otherwise be able to purchase. You'd either have to come out of pocket for the difference, or find another, partner to help you or whatever. It just gives you some flexibility to take to purchase that property when you may not otherwise had the funds to do it. You have an existing property that's in your IRA, and the property is 100% owned by your IRA, and you go, you know what? I have all my money in this property. If I was able to get 60% of that money out of there, I would be able to buy the property across the street and have two. So we have situations like that where they cash out, take their equity, just like you would do a traditional loan. You take your equity out of it and reinvest it. Now, that money stays within your IRA. You can't just take the money and go put it in your pocket or go to Las Vegas. It stays in your IRA, and you want to protect that money. That I referenced it earlier. What I call a golden goose. The money you have in your IRAs is valuable because it's either tax deferred or tax free, and that's the golden goose. Let it keep, laying eggs for you. So this is a way to kind of boost that, and it allows you to take advantage of opportunities that you may have not otherwise been able to take advantage of. Everybody's aware, we all read the newspapers, what's happening in the economy. Not only have interest rates gone up, but basically the Federal Reserve is trying to, basically drive the economy to slow down. They want it to slow down to stop inflation. Well, there's some negative side effects, and if you listen to the Fed chairman's last comments, he said there's going to be some pain. Well, when there's pain, that means there's going to be some people that lose value, lose jobs. There's going to be some turmoil. And I'm not an economist, but you can see what's happening. What they're doing is driving these interest rates up to really slow things down. To slow things down, you're going to have some things that happen that are unfortunate to some people. But if you're in a position of investing at a time when there's pain, and you have an opportunity, you maybe don't have quite enough money, but you say, you know what, this is an opportunity. This prices went down 20% or 30%. I'd like to take advantage of this. I have this window of opportunity for a year or two, whatever. This is the time you start thinking, can I handle a little leverage? Is it reasonable? It's discounted price and possibly be able to have a good enough return to not only pay back my loan, but to add money to my IRA. That's where the advantage comes in here. Like I say, using it prudently, but taking advantage of an immediate opportunity, or you find out your neighbor next door is selling their property and they're moving out of town and they're just ready to go, and you're like, I could buy that. I know what mine's worth. I could buy that if I could just cash out of mine. So that's where a reasonable loan comes in really into existence. It's a way to leverage you at a time that you feel like the return on that property is going to be higher than your rate on the loan, and it's going to give you a long-term opportunity, whether you flip it somewhere down the future, sell it, or whatever. Anybody have any questions on that piece of it? Yes, ma'am. How much money do you have?
I like that question.
Well, no, seriously, there's really no limit except the 40%. If you got 40% down, that's your limiting factor there.
And that segues into the next one. Does it matter where the other 40% comes from?
So, okay, you're talking about putting personal money into it as well? Okay, so if you're wanting to cash out of a property and you have your personal funds in there, you know, we can't, I mean, that would be a conventional loan to be able to cash out of an existing property. You have your personal money. But if you were just say, for instance, you're wanting to buy a piece of property, and you have, say it's $100,000, and you only have $20,000, but you're putting $20,000 personal money in it. You know, that's okay. I'm thinking right. There's no problem with that.
Now you're mixing money.
Yeah, but you have to. But that part that you put in there personally gets handled. That's taxable forever. You can never convert that into IRA money, like you can the loan. The loan, you pay it off. You borrow the money through your IRA. Gary, am I thinking about that right? Or put 20% cash and 20% of the IRA money, and we lend.
The biggest challenge with doing that, though, is if it is a rental property, the hardest thing to do is to be able to split the rent, because it's very, I think the tax reputation on that would be pretty bad, because you've got to be able to split the rent payment up, and a lot of times if you've got a property management company, they're just going to send a check to one person, they're not going to split it.
Yeah, that's the technical part of it. And actually, I've got an example, and this is something that I think Quest can. I know they've helped me work things out before. Where, I mean, I've had properties with me and my wife and our personal funds, and you know, we have money coming in, and generally, I mean, they've always helped us, you know, get that straight. You know, you just have to make sure you do not put that money in your personal account, the IRA money in your personal account. So that's a tricky thing. That I'll defer to Quest to keep that separate. You know, talking to a customer this is kind of an example of both taking advantage of existing opportunity and leverage, and also this issue of splitting money. This is a real life example. A customer came to me and said, "Hey, I own 50% of this undivided interest of this rental property. My partner passed away. His family wants to sell the other half. I don't want to come out of pocket for it. Can I borrow the money?" He owns half of it personally. The other half wants to buy his IRA, and what does it return? It had a great return on it. It was like, I don't know, it was a $150,000 property, and his half was yielding $13,000. It was a great return. I was like, well, you got plenty of cash flow coming in there. So if he borrowed the money, 50% of it, he would have less than 50% loan to value. I said, you could even borrow the money for the closing costs. So say he's at 55%. He doesn't come out of pocket a penny. You know, he already owned half of it. He gets a loan through his IRA for the other half. Doesn't come out of pocket at all. He has a great return on the property. He says in 8 to 10 years that property will pay itself. It will pay that loan off. In 8 to 10 years, he hadn't had to, you know, go get money out of his IRA. He hadn't had to put contributions up. Obviously, there's limitations on how much you can put. He can grow that IRA by himself, and eventually he'll have half of it in his IRA and half of it personally. And it is a little tricky separating. We even talked about at the bank level being able to split it out. We were going to talk to Quest of how to do that if you opened an account, and how to split it out. We'll work something out on that, but that is one of the pitfalls.
And my follow-up question is this an ongoing program or a new program? Because I've never heard of it.
We've been doing this for about 3-4 years, and we've just really reactivated it. And I'll tell you, after COVID, we were doing so many PPP loans, we were just inundated. Everything kind of slowed down. Then the rates were so low, our home lending, we were just so busy, and just, you know, this kind of got kicked to the side, okay? And and we really like doing it. We had bought a couple portfolios of these loans. We had originated some, so it's been something that's been really good for us. It's just timing-wise, we wanted to reactivate it. That's why we went out and did a nice digital presence now where you can go in and get pre-approved easily online, and we revamped the face of it. It's the same underwriting, everything else, but yes, it's been around for a long time. There've been a couple other banks in the United States that do it and do a very good job, but I think maybe we may be the only Texas bank that actively originates. I don't know. Yes.
So what are the, let's say 40K in your IRA, 40K down, next month your AC goes up?
Yes, we recommend about 15% of the loan, and we'll get to that. It's on part of the requirements. We'll escrow for your taxes and your insurance, but we feel like about 15% because sometimes you may lose a tenant. You're right, you may have the air conditioning go out, so that's kind of a rule of thumb.
So you basically still need to count that like 55% of the value we're trying to get.
Yeah, it's like any other conventional property. You always want a little extra there on the side. And it can be money, hey, say you start with 10% and you say, the money coming in, I'm just going to let it build up. I'm not going to turn around and re-spend it. I'm going to keep a little nest egg in here that's just smart for any property, right? Yes, sir. No, sir.
So even like in my case, for instance, my money is in this company. Sometimes the economy doesn't allow me to sell. So let's say if I borrow non-recourse loan for a year and then when the money, when the market gets better, pay it off even within a year or something.
Right. There's no prepayment penalty on any of our loans. Just like, actually, none of our home loan related products do. So that's the flexibility of it is you can take advantage of an opportunity now that you may not want to divest of your stocks right now. Go ahead and invest in them when the time comes, pay it off. But just come back for another loan then. So any other questions there? Yes, sir.
Do you do commercial lending for multifamilies?
We do commercial lending as well. We haven't. We're a community bank, so we do all type of lending. We focus a lot on residential, but we do commercial and for real estate investments. Yes, sir.
Okay. There's some property I want to buy, but we'll cross that bridge once I have a deal.
Yeah. Well, why don't you at least talk to us? Gary is our main lender. I'm the president of the bank. I talk to you as well, but we're here in Austin. We have 6 locations in Austin. No, I'm not trying to promote our bank, but you asked the question, so yes. Sir? Yes, because you'd have to, with the passive deal, I don't know how you get a clear deed to it. I mean, it's between multiple people. So we're talking about individual properties here. Fully owned, yes, sir. It can be owned by several people, but anyway, yes, the syndications that we don't want to get into that. It gets kind of more complicated. Yes, ma'am.
So the collateral is your money at Quest?
Yes, what you would do, the money is sitting there at Quest in your self-directed IRA account. So once the transaction takes place, you buy a $100,000 property, your $40,000 comes out of that account. We send the money to Quest or the title company for the other 60%. So your money gets taken out of your account, goes to closing along with the loan money, and then it closes.
But the collateral is the property itself.
Right. It just attached to that one property. It's not attached to your account. Now, in certain cases, we'll have like an escrow account for taxes and insurance. And there could be a situation. We run into a couple where there's more seasonal rentals, like VRBO type deal. We're starting to get into that. Those are a little less predictable. So in some cases, we may require a little more reserve. That may be maintenance and or cushion there as well. But that's how it normally works. Yes, ma'am.
We have commercial loans that are non-recourse.
Yes.
We have
It depends. It depends. If you want to fix a rate for a longer period of time, and especially in this rising rate environment, if you want to lock it in for 5, 7, 10 years, we would normally have to go borrow that money for the same period of time, and we would get charged a prepayment penalty to pay that back. And so, if it's for a longer period, yes. If it was a adjustable, say a 3-1 arm or something like that, in those cases, we would probably not have a prepayment penalty. Ma'am? A fixed rate loan, you typically would have a prepayment penalty, especially if it's a longer fixed rate loan, yes. But on these, with the IRA, the residential, we don't. Okay. Yes, sir.
Earlier, there were several questions that kind of related to bond. And from a viewpoint of someone who's gotten several non-recourse loans, not from this time. The reason we would get a loan is this non-recourse loan only originally. You can have loans on properties that are non-recourse subject to. If you're going to borrow money on a property to buy an IRA, this is the other kind of money you do. So if you want to leverage a property,
Yes, and it goes back to the IRS rules. I mean, it is your retirement. And there's special rules for your retirement to protect your retirement, and that's one of them. They can't go after you. It can't go after the rest of your account. Thanks for that input. Yes, ma'am.
I have a question on like the tax implications. So if you own like a rental property, you're paying back a loan. You can also put back into the same self-directed IRA the extra rent cash flow that you have.
All of it goes in.
Oh.
If it's 100%, if it's 100% self-directed IRA investment, all of the income goes in there. It has to go
Even
back.
if it's more than 100%, if you're making cash flow on it.
Yes, all of it has to go back.
What happens?
Or you lose your tax advantage. I mean, you don't want it. Basically, it's that golden goose. You want it to go back into that tax-free, so you have that money sitting there to go to invest again tax-free.
And if you hold that property for 20 years, the loan's paid off, you sell that property, those taxes are also, that is also tax-free.
After the loan's paid, so just say for instance you have a 40% loan, and so you start out at 40,000, and then you're down to 39, 38, and then you go to 20 years, and it gets down. Your tax bill is going to get smaller and smaller because it's a pro rata share of the loan compared to the total value of the property. So if your loan only represents 20%, there's only 20% of that you're going to be taxed on.
Yeah, I'm assuming just on the, sorry, the part that was, I guess, taken out of the IRA. That part is completely tax-free.
Yes.
On the settlement.
The part you put in on your IRA is tax. It depends whether it's a Roth or it's a traditional. If it's traditional, it could be tax deferred. If it's a Roth, it could be tax free. Yes. Right, that's what I'm saying. The UBIT would be on that part where it starts out. You got 40,000. That 40% is going to be taxable. Then it goes to 39, 38, 37 until you pay it down. It gets smaller and smaller, the percentage. But you apply a pro rata share of the depreciation and pro rata share of the expenses. And so if you have a property, it's going to be pretty minimal. They went through that in the expo. I don't know how many of y'all went to the expo. They did a very good example. And the bottom line, they said, you know what? If you have a property to invest in, you think you can make money, don't sweat the taxes. If you're going to be doing a traditional property, you got to pay taxes on it. Use all the advantages of your depreciation and everything. It's about trying to invest it prudently at the right time and a good return.
You also mentioning a tax that I'm not familiar with.
UBIT, unrelated business interest tax, that's what it falls under that category, and I'm not a CPA, but that's what it falls under. It's called unrelated business interest tax, and it was passed in some bill where it got thrown in with the churches, and it's a story to it. Because it's going to be taxed, and they said, oh, wait, we got to find a way to tax it. So it fell into that category, but it's really similar to regular income taxes. You just have to make sure you file the right form. Your accountants fill the right form and put the amount of taxes. Yes, ma'am.
There is a ceiling of how much money you can put into your IRA. There is a ceiling you can put unlimited funds.
Yeah. Exactly. Well, but see, here's and he just mentioned this. It's not about what you put in it; it's how much you earn. That's where you get ahead. So, this is where I'm talking about even leveraging from a loan standpoint. If you have a finite amount, just say you end up leaving a job and you've got $30,000, and then you're putting $6,500 a year, and you build it up, and you got $40,000. That's all I got. I can put $6,500 to next year, or if you're over 50, you can put $7,500. So you think, I'm not getting anywhere here. I'm not moving very fast. But if you're able to leverage yourself a little bit and take advantage of an opportunity that yields a 50% return when you sell it, then all that money goes back in the IRA, and now your IRA doubles. So that's the game. And if I've talked to a couple of the younger people, I was like, start when you're young. Start when you're young, where you can start building this up and start taking advantage of some of these opportunities that build that golden goose up. Yes, sir. You'd have to ask your CPA about that, but that may be true. Yeah, that'd be worth looking at. Yeah, you just need to be aware. You just need to be aware of it.
You're fine on time, but we do have online audiences, so can we save the discussion for later and continue? Just
Okay.
So the online audience gets.
Well, good. Yeah. Okay. So profits and earnings always go back into the IRA. We'll get into some of the documentation to do the loan. Loans are non-recourse. We talked a lot about that already, and it's secured by the collateral. Okay, let's see. Qualifying. Here we go. Okay. So your down payment is typically coming from your IRA. There's no minimum, maximum loan. We will verify the reserves. Typically, we'll get 3 months worth of reserves. Just make sure you're going to be able to have some excess in there to take care of those contingency. The minimum debt service coverage ratio, and I'll have a calculation that'll show you exactly how we do this, but basically what it amounts to is your property has to net return 1.25 times of what your payment is. So, if your payment is $1,000, your property needs to be making $1,250. And so what it amounts to is you're putting enough equity in there that if you got a decent property, it should yield that. And what it does is it gives you a little cushion, so you've got a little bit over and above the payment, that money goes into your account. And we'll go through the calculation here in a few minutes. Oh. Okay. So there is a standard appraisal inspection, and we'll either, if the property is already leased, we'll take consideration the current lease. If it's not leased, we'll want good rental data and support for what that property will return. That's for us to be able to, not only from the bank perspective, but from your perspective, your IRA's perspective, we want to make sure this property is going to cash flow for you. We're going to help you look at that, and having that extra cushion, making sure it has a decent return. That's what, debt service coverage ratio and looking at the appraisal. And it's going to be tools that help you as well as the bank. And then it closes like a regular loan through the title company. It'll just be the loan's going to be in the name of your IRA for the benefit of Jane Doe. And it's a simple process, just like buying the regular property. It's just you have a loan involved, and that money from the loan goes to the title company. Make sense? It's pretty simple because you don't have all the underwriting you typically have on credit scores and all the I guess, global cash flow and so forth. Yes, ma'am.
I think you answered it when you gave the example earlier, but if you have the benefit of buying something, say, $100,000, and you can get it for less than 60%, then it's still not out of pocket. You're okay with that, or do you still have?
No, typically banks, whether it's a conventional loan or IRA loan, we lend based on the lower of cost or appraised value. So it's just, I mean, if you got it for $60,000, it's probably worth $60,000. So that's the way we look at it. Now you can still take advantage of that and say, well, I got a good deal, but and you may get it on the back end, and that's great. It goes in your IRA, but we're normally going to look at the cost or appraised value, the lower of the two. Okay.
Oh, wait, I have a follow-up question. So what about an appraised value after repairs and stuff? Like, as far as borrowing that money?
We don't do a lot of the fix and flips and stuff, and that may be something we could, but generally what we would do on repairs, we would ask the appraiser, go ahead and get an estimate of what repairs need to be made, give a copy of that to the appraiser. They'll take into consideration the house and what repairs are going to be made, and they would say, okay, as completed, this is what the value would be. And then we would make you escrow that account, and that money would be sitting there for those repairs, and we would disperse those funds as the improvements were made. Okay. So, depending on the lender, there's different goals, but most of them are pretty consistent. Properties don't get real complicated. We generally focus on the single family, the condominiums, duplexes, fourplexes. The key is that from the property standpoint, it just has to generate sufficient net income to be able to pay your loan and hopefully make you some money in the long term. So that's the main points there. And then we have a two-step process. Just it helps sort of filter for you as well as the bank. We have a online portal that or just IRAloan.com. You go on there. There's 4 questions. Do you have a self-directed IRA? Well, you say maybe I don't, but maybe I need to get one. So you can probably control that yourself if you've got money in an IRA. Number 2, do you have a property identified? Number 3, what state is this loan in? We're slowly building outside of Texas. We've got several other states that we're adding, but make sure your lender lends in that state. And obviously, we're talking about Texas here. Yes, we lend in Texas. And then, do you have enough equity down payment to put in? Do you have the 40% of that property value to put into it? So we have that online, and you answer those 4 questions. It says if you've answered these 4 questions, you probably can move to the approval process, and it's another little step with more details of the property and so forth. I'll answer that question in a minute. So this just kind of gets you in the ballpark and makes you start thinking, what's the minimal prerequisites that we need to be able to get a loan? Now, you'll have our contacts. You want to pick up the phone and say, I'm really interested in this. I have the money. I've been wanting to sell a self-directed IRA. There's a property right down the street I want to buy. What I need to do, we're going to say, go talk to Quest, set up an account, and we can be talking about this. And we've done these loans where people qualify, and they had all the other prerequisites. They went ahead and set up the account to do the loan at the same time. So obviously, Quest is very efficient at doing that. But those are the basic 4 questions to get you to second base. All right? Yes, sir. After it qualifies, how long do you need to close the loan, to get the loan? It's typically similar to any other real estate transaction, 30 to 45 days. I mean, some title companies are slower. Sometimes, you have a situation where, they're busy at the title company, but 45 days is a good estimate. It depends. If you're setting up an LLC and you need a little extra time for that, it could drag it out a little bit further. But typically, the loan itself, once you get everything in and get an appraiser done 30, 45 days. Okay, so I mentioned earlier calculating the debt service coverage ratio. So here's an example. Purchased a $300,000 property. You borrowed we borrowed $150,000, and we have a projected annual payment based on the current rate. So that payment would be $11,820 a year, almost $1,000 a month, $990 a month. All right, so you take the rental income 12 months times 2,200, it gives you $26,000 in gross income, and then we estimate the taxes, the insurance. We typically put a 4% vacancy built in, the maintenance of 3%, and management fees of 6%. And if you can prove it's less, we'll do less. So you got $15,000 in net operating income. You divide that by the $11,820, and you get a debt service coverage ratio of 1.32. Typically 1.25 to 1.3 debt service coverage ratio is what a bank is looking at to qualify you for a loan. You want the property to be, self-paying, liquidating, and take care of the payments and leave some money in your IRA. Does that make sense? All right. All right, we're now down to the frequently asked questions. I think we have a mic. If I have some of them, some sample ones. We probably already went since you guys are such a studious group here. Y'all have asked a lot of good questions. All right, can I use my existing retirement account? Yes, if you have a self-directed IRA set up. It has to, if you want to invest in real estate, you can't just take your account that you have your stocks in. You have to set up an account with Quest or a custodian. How do I pay for the property expenses and process the rent payments? As I mentioned earlier, the key thing is it all has to be run through your IRA. You have to make sure it goes through your account. So the normal process, most cases, people have a management company, but if you're a professional manager and you can prove that you've experienced at this, we'll allow that. But typically, we build in, room for a management company to professionally manage it and collect the payments and make sure it gets, written out the right way and sent up to Quest. And so it's all through that process. Any questions on that? I know we talked about it earlier. Why are reserves required? We have the, A student up front. She asked that question a long time ago. But yes, things happen. Things happen, right? That's the reason. And so build yourself a little cushion. Don't get upside down on the deal. Have yourself a little cushion so you don't sweat through it. You may, you got an unfortunate situation and you're not planning to put the next contribution in till next January. You may have to do it early. You may have to double up and do both 22 and 23 in January, February of 23. But in most cases, having that cushion helps you. Who coordinates the taxes, insurance, and mortgage payment? So I had that little triangle there earlier. If you remember the little triangle, that's a good perception of what we have here. You have you as the IRA holder over here, but you have the custodian, and you have the bank, and you have the property. And so the property, you have to figure out what the taxes are and everything. And so there's a coordination between the bank and the custodian and the taxing office, and you're going to be sort of in between making sure things get paid, because what they're going to do is they're going to send a statement to Quest, and it's going to be on your message board, and you're going to pull it up and say, okay, here's what the taxes are. Now make sure I got enough money in the account when it does get paid. Or in the case of if you have a loan, we would typically escrow for that and then monthly take the money out. So you keep that current, and you're typically always going to have 3 months extra in there. But that's all coordinated between the custodian, the bank, and you, and it all kind of ties together. It's similar to a conventional loan, except you have the custodian involved that you need to make sure that everything gets transferred through them. Yes, sir.
Will that include the UBIT?
You know, the UBIT is not going to be addressed from a bank loan perspective. I mean, you're going to have to talk to your accountant about that. That's going to be calculated at the end of the year. Like we said earlier, if you have that UBIT, I mean, all the money because it's a loan to the IRA, and if you don't have any other personal funds in it, all the money is going to go into your IRA. So it's just a taxing consequence at the end that they'll have to calculate for you, but it's not going to be taken into consideration here. Can I cash out equity from existing property? We talked about that. You can. It would have to be valued and appraised, and it's a good tool if you have an existing property. And you may have something that you bought 5 years ago that now is worth 50% more, and so you have good equity in it. Will non-traditional properties qualify? Okay, so I say yes, but we just have to make sure. That they're income producing, and they're a good example of what we'll do, because we're a bank, a community bank, and say, for instance, you buy a piece of property that has an extra 2 acres of land on it, and some banks may look at that and say, I don't want anything to do with that. It has land on it. I don't understand that. That's an example. If it cash flows, rented, has a couple extra acre land, 5 acres of land, you know what? We would do that. That's an example where we would stretch outside the normal limits of what a bank would do. Condos, townhomes, we'll even, consider, like I say, short-term rentals. We're going to be a little bit more particular about those. If it's a short-term rental, vacation-type rental, we're typically going to advance 50% rather than 60%. And you're going to have to make sure you follow the IRS rules to make sure you qualify it as an investment property and not a personal vacation home. So there's a few things like that. You just have to, talk through it, and we have local bankers. Gary will be the main loan officer on the deal. You can pick up the phone and talk to him about the property, and we'll talk to you just like we're talking tonight. Yes, sir. A non-traditional? Well, it would be like a non-warrantable condo, or like a house with extra acreage on it. Something that's not your traditional rental property or condo. It's outside the norm of what, and I'd say the norm of what FHA guidelines would normally would qualify. Okay. So we kind of answered the question on the short-term vacation rental. You just got to be a little bit more particular on that, and you got to remember there's seasonality. I know that a lot of the rivers were low this last year, and people had rental properties, and people just forgoed their 50% down, deposit, and so you got to be prepared for that, because it's not as typically as predictable. Do I need a property management company? If you can convince us otherwise, we'll listen. But I think it's a good idea, especially if you're an absentee, type of owner. Okay. Any other questions on those? I think y'all did such a good job answering all the questions during the. Yes, sir. Mm-hmm.
I'm kind of curious what your website is like on the website.
Gary, to be able to see the loan, this is like any other loan.
Online banking.
Yeah, you got online banking. You should see every payment coming in, and it's on. I mean, we book it just like a regular loan.
You get signed up for online banking, you have access to see your account balances on anything.
One more question, sir. Do you hold solo 401k money?
We haven't got into that. I think we have the ability to do that. It's like the LLCs. We're doing some LLCs now through IRAs, so it's the same thing. We're actually working with one right now. We'll double check. Gary can double check, but I think we can do it if it falls under the same rules as an LLC. Just a little bit more about us. We're a full-service community bank, independently family-owned. Been over actually 102 years. We were formed in 1920. Our motto is flexible, friendly, common sense financial services. So
102 years old, though.
he may think I am. I'm only 99. So, we'll lend all over Texas. We're doing lending in Colorado and Colorado, Utah. We got a lot of demand in Tennessee, but we're adding on as we have demand. So, I think we have some contacts here. We have our cards over there. I think we about burned up our hour.
You're good. You're good. I will say if anyone else has any questions, just raise your hand. I'll come hand the mic to you. But we did have one question from one of our online attendees. Can you close in under 30 days?
It's possible, but not probable.
Well, I mean, the whole key to it really is how fast you can get an appraisal. I mean, we can underwrite the loan pretty quickly. It's just how fast can the title company move and how fast can you get an appraisal and, documents usually you get those done in a day or two. So, I mean, it is possible. It just, in today's world.
If everything went really smoothly, our approval process is pretty much electronic. We plug in the numbers, and it spits out, boom, and you either qualify or not qualify. If you have anything outside of that and you want to talk about that, that's a little unusual, may take a little longer, but yes, Gary, you're waiting on the vendors to complete the title policy, and the appraisers are the ones that, surveyors.
We understand that from a custodian standpoint. You definitely have to wait on some other people. Okay, does anyone else have any questions? If you do, please raise your hand. I will hand you the mic. Any
It's
questions?
showtime. It's time
Any
to do it.
questions? Any questions? I do realize y'all answered a lot of them through the presentation. All right, y'all, give a round of applause for Derek, please. Or David, sorry.
Thank y'all very much. Y'all been a great audience.
The presentation will be recorded. We will send all of y'all here a link tomorrow. So if y'all do not get a picture of their contact information right now, or if you don't grab a card from them, you'll get this information tomorrow. For our socials, the way that we like to end them is deal pitching. So if anyone in the audience has any deals, services, or anything like that you'd like to pitch, please feel free to come take the mic from me, and you have the floor. Anyone? No? One?
Hi, my name is Alex. I'm a local real estate investor. We buy and sell homes, owner finance them, and we have some first mortgage secured owner finance notes, about 50 to 60% LTV, about 10% yield or so. It might work for your IRAs or personal cash flow needs. Size is 170 to about 350 or so. I guess come grab a little card or I have a little flyer with me. Thank you.
Hi, I'm Bill Kreider, and I'm a private lender, and I do have money to lend for real estate investments. Must be secured by real estate here preferably in Central Texas, and my rates are comparable to hard money lenders, only a little bit better. I'm a relationship lender. I'd like to establish a relationship with you and loan to you many, many times, so I've got to give you good rates so that you'll keep coming back. All of the money that you would be borrowing from me is going to come right out of my account here at Quest.
Do you have a deal, or do you have something funny to say?
I unfortunately don't have anything funny to say. I'm a very serious man most of the time. But I am in the process of developing 3 duplexes or quads up near Eddy, Bruceville, Texas. So we're looking for a third partner who is interested in financing some of the details. Some of it, we haven't quite figured out the details yet. We're doing a water study right now, so we should have results soon. My name's Rob Birch, and you can hit me up afterwards.
Okay. Anyone else?
Hi, I'm Michelle Hill with Lotus Solutions and Bespoke Capital. What we offer is opportunities for IRA investors to fund acquisitions of deals for the short term, and then we do convert also to owner financing. And like Alex said, we are then putting longer term financing into place with private lenders that want to hold these assets in their IRA at anywhere from again, 50 to 60% LTV typically, with a minimum 10% return typically. And all of our loans do go through full underwriting processes through title companies and are fully serviced by a third-party servicer. And I think that covers all of that. Oh, and yeah, you can just see me at the back, and I have a card.
Okay. Anyone else? Going once.
Hi, everyone. My name's Rebecca. I'm a native Austinite. I've been here all my life. I am what most people would call a bird dog, so I was able to meet a couple of you. But I work with my dad. We find deals. I've lost deals because I can't find an end buyer fast enough. So if you like someone to find you deals and you want to get 12% on your money, please let me know and meet me afterwards. I would love to get your number and contact information. And just like Bill had mentioned, I also love building relationships. So I'd love to treat you to coffee. I'm a web developer. Personally, I work from home, so I have lots of time. So please let me know, meet me afterwards, and hopefully we can build a relationship.
Okay. Anyone else? Right. Well, that concludes our evening. I will say, if you have an IRA, you're definitely going to want to get their contact information, because the only loan your IRA can get is a non-recourse loan. So if you have an IRA, you want to go visit that table over there. Thank you for joining us tonight. Please remember, this event is hosted every second Tuesday of the month. We always have a new guest speaker. It's a great chance to get more education, network, and deal pitch. Thanks for tonight. Feel free to network.